I wanted to start off by just having you compare and contrast enterprise venture capital investing versus consumer investing. And, when we talked before this, you had a really great point that if you're a consumer investor, you're much more kind of anticipating where the market is going. And if you're an enterprise investor, you're more focused on pain. Flesh that out a little bit more and talk about how those two things are so different.
So at Greycroft, we're about half B2C, half B2B. As you mentioned, I spend most of my life on the B2B enterprise software side, but I obviously watch our consumer team, who's very talented, has a great track record on this stuff. They think the consumer deals, of course, are more sexy, but I beg to differ with that. But the thing that I find fascinating about watching how they analyze these deals is they really spend most of their time understanding trends, where the market's going, and anticipating what that means for consumer behavior. And really, a lot of the things that they're excited about and that they really believe in are things that are not necessarily intuitively obvious at the time. And that takes some real conviction, because I think all of us as investors have a habit of trying to assume that we're the consumer on consumer investments, and that's a very dangerous habit to fall into or trap. It's hard to not do, but our consumer guys who are very good at this always remind us it's all the data. You got to really understand the data and the trends and what's happening. It's not, would you actually do this as a consumer? Because we're hardly ever the target consumer for most of these companies. Occasionally we are, but almost never. And so on the B2B side, it's a little bit different. Here, to me, B2B investing is all about pain. It's pain identification, right? These big companies, or they're small companies, right? Whoever the business buyer is, for them to go with a startup over the myriad of other choices they have of third-party vendors that are more established, or trying to build something on their own internally for people that have resources to do that, the pain has to be so high for them to give a small, unproven startup a chance. And so that's the number one thing we start by looking for, is that serious pain. And then we look for major macro trend currents. So big mega trends like the movement towards the cloud or interoperability of data across an AI, these big mega trends that are moving the markets in certain directions. And I kind of think of it as like a river. If you're kind of trying to get from point A to point B down a river, you really want to be paddling with the current, not against it. And so we start by looking at those big mega trends, so we kind of have a sense of the current and how fast it's rushing in the water. And then we look for pockets in those markets where the pain is really high. And then we try to find the best player. Ideally, it's a seed stage company. We can get in early and ride it all the way. But sometimes we're a bit late and we notice that the best player is actually a little bit further along. And then we'll try to jump in with our growth fund there. So we take kind of a very sector-driven, kind of mapping-based approach of these different pain areas. And then we figure out what's the best player. Should we start a company back or very early stage company, or should we find the best player who's they may already be reasonably big and the valuation might even be reasonably high, but they're not even through the first inning of a 9-inning game and they're already the unquestioned leader and it's got massive running room, right? Those, we love those too. So that's how we think about it.
Just to dive in a little